before coming in, Mayuresh, I'm going to come to you and I want to get a little sector specific here. Let's talk about three sectors in focus. First, on the gaining side, you have the real estate space, right? Do you still see more legs for this rally given that the PMAY has been extended? And on the flip side, you've seen FMCG and IT being the top laggards today, and I can't help but notice that the top Nifty losers, 4 out of 5 are from your FMCG and IT, likes of HUL, Infosys, Tata Consumer and ITC. What's your outlook for this space going ahead, as well as do you see more legs to the rally when it comes to real estate?
So I think it's a natural trend. If the market is in momentum, I think a lot of these defensive spaces go into a relaxed mode, right? So to that extent, I think how the monsoons play out and what the initial signs are being seen of a very normal monsoon this time round, above average in some areas as well. I think you might expect a decent rebound as far as rural incomes are concerned. Rural is still a large part of FMCG sales, and therefore, as rural incomes will start coming back, and there is a definite trend of discretionary spending coming back to the forefront, you will see volumes pick up quite significantly. So I think a lot of ad spends that is happening, a lot of grammage increases that is happening without any price increases might just normalize, leading to better numbers from second half for a lot of these FMCG players. For reality as a space, I think we're still going through that 6-year cycle in the third and the fourth year. 2 years still to go. Historically, as we've seen real estate cycles play out, pre-sales velocity for most players, you've seen launches by DLF getting sold off in a week. A few launches by Soba, as an example, have got sold out. There was a launch by Kolte Patil in Kota, which got sold out in a matter of weeks. And therefore, I think the appetite in terms of premium and and above par properties, which is above notional values, which an average investor probably pays, is still looking very, very good. And to that extent, I think real estate developers have done well. But real estate ancillaries is something that one should now start focusing upon. Greenlam Laminate, Century Ply is an example, right? They're just about right at this juncture. They've gone through a lot of input cost inflation pain in the past few quarters. Volumes will come back because as new houses are now getting built, you'll obviously need refurbishment happening in those new houses, and existing houses will continue their mode of refurbishment as well. So I think real estate proxies, ancillary stocks might do well. For IT sector as a whole, my whole take is that wait out for Q1 numbers. Mid cap IT relatively better fared compared to large cap. Order flows have remained consistent, margins have remained consistent, commentaries related to both revenue growth as well as pricing have remained consistent as well. The valuation and late stage basis is something one needs to comprehend with. But for large cap IT in general, I think what probably happens with three of their biggest spaces, BFSI is still going through some element of pain in North America. Retail and manufacturing, both in the Euro context and the American context, should start showing signs of recovery in the second half. There might be some element in terms of frothiness as pricing and orders are concerned. So wait out for numbers for Q1 for large cap IT, but anybody holding mid cap IT can continue.
If you like this video, then like, share and subscribe to ET Now.